So let's get into the building blocks of the model. That starts with the macro factor information set. So when you think of a fundamental cross-sectional risk model, these are well established. We have a starting point where we know the factor exposures, and then we solve for the factor returns. But for us, the challenge is in reverse. We know how macro factors move, but it's our job to solve for the asset's factor exposures. But the very first thing you have to decide is what factors. Now, macro is not a big data problem. We don't want to throw in hundreds of factors into the mix and see what sticks. The evidence in our experience indicates that stock price variance can be well explained by the interplay between growth expectations, financial conditions, and risk appetite. So in our standard US risk model offering, there are 12 macro factors that reflect these three broad buckets. So within growth expectations, we want to know about real-time GDP nowcast, commodity prices, copper and WTI crude. We want to know about the 530s curve, where the steepness typically tells us about medium-term growth expectations, but more recently it's been seen as a proxy for the Trump chaos risk premium with the recent steepening, and also inflation expectations. For financial conditions, we want to know about 10-year rates, both real and nominal, high-yield credit spreads, the trade-weighted dollar, Fed quantitative tightening expectations, which is essentially looking at interest rate vol, and rate hiking expectations, which is looking at the size of expected Fed cuts. For risk appetite, we look at equity vol. So all of these factors are tradable, with the exception of GDP nowcast, where we're using daily real GDP estimates. And we'll adjust these set of factors to be applicable for each regional model.